Short selling and margin trading are both advanced trading techniques that involve borrowing assets to potentially profit from market movements. However, they serve different purposes and involve distinct processes. Here are the main differences between short selling and margin trading. Short selling. Purpose. Short selling is primarily used to profit from the decline in the price of a security. It involves selling a borrowed security with the hope of buying it back at a lower price to return it to the lender, thus making a profit from the price difference. Process. In short selling, you borrow shares from a broker or another investor, sell them on the market, and aim to buy them back at a lower price later. You then return the borrowed shares to the lender. Risks. The potential loss in short selling is theoretically unlimited since there's no upper limit to how high the stock price can go. If the stock price rises significantly, you might have to buy back the shares at a much higher price than you initially sold them for, resulting in a loss. Margin requirement. Short selling typically requires margin, as you need to provide collateral to your broker to cover potential losses in case the trade goes against you. Profit potential. The profit potential in short selling comes from price declines. If the stock price drops significantly, you can buy back the shares at a lower price than you sold them for, pocketing the difference. Margin trading. Purpose. Margin trading involves borrowing funds from a broker to buy more securities than you could with just your own capital. It's used to amplify potential returns when you believe the market will move in your favor. Process. With margin trading, you're borrowing money from your broker to increase your buying power. You invest this borrowed money, and your returns, or losses, are calculated based on the total amount invested, your own funds plus borrowed funds. Risks. The risks in margin trading are that you're not only exposed to the potential gains of your investment but also to the potential losses, which can exceed your initial investment. If your investments decline significantly, you might need to repay the borrowed funds even if the value of your investments is lower than the borrowed amount. Margin requirement. Margin trading requires you to maintain a certain level of equity in your account, known as the maintenance margin. If your account value falls below this level due to losses, you may face a margin call and be required to deposit more funds or sell assets to meet the margin requirement. Profit potential. Margin trading allows you to increase your exposure to potential market gains. If your investments perform well, the returns are calculated on the total invested amount, which includes the borrowed funds. In summary, short selling is primarily used to profit from price declines and involves borrowing and selling securities. Margin trading involves borrowing funds to increase your buying power and invest more than your own capital. While both techniques involve leverage and carry risks, they have distinct purposes and potential outcomes. It's important to fully understand the risks and mechanisms of these techniques before engaging in them. Created by Sasanka Da Silva for the King's Exploits channel. Thanks for watching.